Australia's economy and our property markets don't operate in isolation, so I believe it's good to regularly have a look at the big picture, the macroeconomic factors affecting not just Australia's economy, but the world's economy. And to help us understand what's ahead for us, I do this once a month in these big picture podcasts with Pete Wargent. While regular listeners will know Pete well, if you're new to this podcast, well, firstly, welcome, because I see that there's thousands of new listeners every month, so welcome. But the reason I'm keen to discuss these matters with Pete is because he's not just an academic, even though he's got great academic credentials as a chartered accountant, chartered secretary, and he's got a financial planning diploma. But I enjoy my chats with Pete because of the credible perspective he brings on what's happening around the world, because he's an international investor and business person. Now, since this is our last big picture podcast for the year, Pete and I are going to give a short review of what's happened over the year and our thoughts about what's ahead for our economy, Australia's economy, and our property markets. So, welcome to today's show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment, and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
As I look back, 2021 seems to be a year that's gone pretty quickly for me, even though I know there are a lot of people found it a slow year, a difficult year. It's been a great year for my business at Metropole, where we've helped more people than ever secure their financial future through independent wealth and property advice and advocacy. And it's been the best year in my memory for the growth of my own personal property portfolio. And I know for most people who own property, it's been a pretty good year also. Yet I recognise that some people have experienced tough times related to their health, to their business, or financially. And I'm not saying it flippantly, in most cases, it was totally out of their control. It just doesn't seem to be fair, does it? So what's ahead for us? What will 2022 bring? That's what I'm keen to discuss today in this month's Big Picture podcast with economic analyst Pete Wargent, a lifelong student of and commentator of our economy. Hi, Pete.
Hi, Michael. Good to be on.
Now, you're still over in the United Kingdom, even though I know you're coming back to Australia. And every day there's some new news about COVID and the latest variant. And it's interesting to hear what's happening on the other side of the world. So before we get into the economy, so what's been happening in Europe and what have we got to look forward to here in Australia?
Well, I guess the thing in Europe is that it seems to have been a very seasonal virus. So the last couple of years, we've seen the same thing. Now we've seen very high case numbers, particularly in countries like Germany and elsewhere. But actually, certainly in the UK, where I've been for the past few weeks, the case numbers have been high, but the hospitalizations are actually trending lower. And that's because we're on to the third dose now of the vaccine. About a third of the adult population, or about 20 million people, have had their third dose. So even though there are a lot of case numbers, they are skewing younger now, and there's far fewer serious cases. And the hospitals are, well, there's less than a fifth of the number of COVID cases that there was at the peak. So still some pressure on the NHS, but it's not all related to COVID. It's the usual winter story. So yeah, there's still a lot of disruption, rules here and there about masks coming and going. But I think realistically for Europe, as soon as they get into the warmer months, things seem to improve. And I think this time around, hopefully that will be the last time we have a bad winter.
Well, that would be great. Now, Pete, talking economically, I guess we could say this has been 2021's been an average year. I'm not belittling how well our economy's performed, but by that I mean it was better than last year, and next year's going to be better. So I guess that mathematically that makes it average. But having said that, though, the economy hasn't performed as strongly as some had predicted at the beginning of the year, and that's because the Delta strain of the coronavirus and the lockdowns in Melbourne and Sydney caused a slump in the September quarter. But even the latest results of how our economy performed has actually surprised a lot of analysts on the upside, haven't they?
Yeah, so I suppose a lot of the year-on-year numbers at the moment sound very extreme or wild, and that's because we've seen a couple of cases now where you have lockdowns and then the economy comes flying back on the rebound. Essentially in Australia, that's happened twice. Now, the economy was pretty much back on trajectory until the third quarter of this year, when Sydney and Melbourne were both plunged into lockdown, and there's restrictions in Canberra. So effectively, I had half the country not operating at capacity. So the third quarter, the economy shrunk by just a bit less than 2%, not as bad as feared. Hours worked were down about 5%, which is probably a better reflection of what was going on. But I think, as we've seen elsewhere around the world, when the economy reopens, it tends to come flying back. And I think there's a few reasons to be optimistic, not least the huge war chest of household savings that have been piled up there, hundreds of billions of excess savings.
Well, Pete, last month in its quarterly statement on monetary policy, the Reserve Bank of Australia gave its usual three scenarios. Now, if the upside scenario was achieved, Australia would experience a real booming economy off the back of strong property prices, surging household spending, a sustained global recovery, and it would assume, of course, that we're going to be able to suppress COVID. The Reserve Bank said this could even lead to unemployment levels as low as 3.25% next year. Then, of course, it gives the central scenario, which still would be very good, and even the Reserve Bank's downside scenario, which would occur if there was lots of health outcomes lingering on, and that would affect the economy. Pete, even that looked pretty good. But the market speculators are now commentating on what's ahead. Where do you see the economy going in 2022?
Yeah, well, I think with all of that household saving that I mentioned, I mean, households are sitting on about 1.5 trillion of cash and deposits. We've never seen anything like that before. So I guess when people are able to spend again, a lot of people won't travel overseas just yet because of all the rules and restrictions. So that money's going to start circulating in the economy. Now, very difficult to forecast at the moment. As you mentioned, the Reserve Bank has got a very broad range of scenarios. I guess unemployment in the base case scenario would be heading down towards about 4% by the end of next year. I suppose the big question that everyone's asking is, well, if that's the case, do we start to see stronger wages growth? Will interest rates actually start to rise? Because at the moment, they've been pretty much stuck at zero. So that's the big question. Now, if things go well, potentially we could see an interest rate hike in the back end of next year. But at the moment, it's still quite a way off.
Well, that's obviously the underlying assumption that some of the property negativists are coming up with, and maybe we can talk about that in a moment. So on the one hand, the Reserve Bank believes our economy is going to do well, but in general, the economies of most of the world are going to perform well next year, aren't they? So we're not operating in isolation.
No, it might take Europe a bit longer to get back online, but eventually, particularly in the developed countries, vaccination rates are now very high, and eventually, with all the stimulus that's been pumped into economies around the world, I think you can expect some pretty strong growth, and probably about 5% for Australia next year in the base case scenario, and the same again for 23. So when things get going again, we'll see the rebound is pretty strong.
Now, that's great. So clearly the Reserve Bank's interest rates are stimulatory. As you said, there's still stimulus happening, and in due course, they're going to raise the interest rates, but they're going to wait until inflation remains, not just once or twice, but remains in their band of 2 to 3%. And of course, they're also going to want wages to go up, because it's no use putting up interest rates if people can't afford to pay more. But there's a lot of talk about inflation. There's inflation overseas. Australia's official inflation rate currently is a solid 3%. But I mean, that was just a one-off thing. Many countries are now 4, 5, 6%. The US is 6.2%. That seems to be scaring people, Pete. But a little bit of inflation, controlled inflation, is good for an economy, isn't it?
Yeah, so in Australia, I guess inflation's actually been under target for about 6 years. So we're due for some inflation if the Reserve Bank had the settings right. As you mentioned, headline inflation has got back to 3%. The preferred core measures, that the sort of underlying measures of inflation, are still in the low twos. And it looks as though the Reserve Bank would like to see that back towards 3%, really. And in particular, wages growth at, say, 3.5% or higher, and we're nowhere near that yet. There's another factor that sort of feeds into this, and that is immigration. If immigration starts coming back quickly, then that could actually keep a bit of a dampening effect on wages growth. So we'll just have to wait and see how the new year plays out. But the Reserve Bank is adamant there's no interest rate hikes coming anytime soon, more likely some way down the track.
Well, with immigration, it's not just the normal immigration, but if the government's going to bring in those 200,000 skilled visa holders, it'll be a bit of a sugar hit, won't it, in some ways? So that will fill up some of the jobs. I've been speaking to people, to clients who just can't get enough employees at the moment, so that they'd be happy with that. But it's also going to put a strain on our housing markets where, I don't know, if 200,000 people come in, maybe we're going to need accommodation, 100,000 units of accommodation somewhere. That's going to make things interesting, isn't it?
Yeah, so we actually saw the immigration cap was reduced a few years ago. The permanent migration cap was 160,000. It doesn't always work out to be exactly around that number, but there is talk about increasing the cap again because we do have in some sectors of the economy a skills shortage. Some of the big tech firms, for example, are just really struggling to find talent. So Australia doesn't want to miss out on the talent as the world gets back online. It's always different in an election year because the government won't want to stir the pot too much because there's a lot of debate about the merits of a big Australia or otherwise. But it wouldn't be hard to envisage a couple of 100,000 from net overseas migration per annum for the next few years. But also, of course, you've got the natural growth of the population on top of that. So we could see population growth back at, who knows, 350,000, maybe even 400,000. So the demand for housing is going to come storming back over the next few years.
Sure, well, that argument about population's already reared its head. Hey, we haven't got jobs and you're going to take our jobs if you bring in all these new people. But after the World War II, Australia learned that if it had to grow, if it had to prosper after a big hit, and we didn't go through a war, but really in some ways it's closed our country down a bit like that did. After World War II, it realised that we had to have immigration to grow, to prosper. Over the last couple of decades, I think people started to question the value of migration as migration boomed. But you're a migrant, I'm a migrant. In fact, most Australians are. And if it's controlled, if it brings in skilled people that are going to pay taxes and buy goods, that's actually good for the economy. But we're also going to need to bring those students back, Pete, aren't we, to fill all those apartments close to the universities and near the CBD and keep our tertiary education system functioning well.
Yeah, so I guess the argument against immigration usually circles around housing affordability, pressure on infrastructure, traffic issues, and those sorts of things, putting pressure on Australia's creaking infrastructure. And we do have some of that. I suppose the reason that governments have tended to like it, well, it's a sugar hit for GDP growth, obviously, but it just tends to, slows the aging of the population because new migrants tend to be younger than the median age. So I'm a good case in point. I applied under the skilled points test many years ago now, but because I was under the age of 30, you get extra points. And as you mentioned, international students are another big factor in terms of the temporary visas. And again, that people who are younger than average and the skilled migrants will pay tax and be in the workforce for a very long time. So they'll increase the participation rate, the tax take, they increase the skills around the country. So overall, it's a net benefit. The pressures to manage are really, when immigration is too quick, you do see pressure on things like traffic and infrastructure, and that's kind of unavoidable.
So it has to come with infrastructure spending as well, doesn't it? But we shouldn't take it for granted. A lot of people did want to come to Australia, but other countries are now chasing the same potential immigrants that we are. There's competition out there for people from our region, for people from Hong Kong, for people from India. Canada has had similar labour shortages to Australia, and its immigration rules have changed, and it seems to be beating Australia in attracting some of the best migrants. And I believe the UK's already joined the race too, Pete.
Yeah, that's right. I mean, if you look at, where are the desirable places to live around the world for young professionals, places where they can bring up a family safely, good lifestyle, well, Hong Kong has kind of dropped off the list, sadly, in recent years because of political changes. So Canada and Australia are always right at the top of those lists alongside the US and the UK. Australia has always been a great lifestyle destination. Last couple of years, we've done ourselves some damage in terms of reputation, I think, because of the sort of authoritarian rules around the virus. But I suppose the flip side of that is Australia has actually managed the health issue, much, much better than all of Europe, America, Canada. So Australia and New Zealand, I think they'll be pretty much front of the queue for a lot of people in the years ahead.
I think that's going to underpin our housing markets, but most of these migrants are not going to be able to buy a property till they've been here for a while. It depends what sort of visas they come on, of course. So I see rents lifting considerably. Already there's a shortage of housing, and rental accommodation in housing now has seen rents rise the most they have for a long time, around 10% over this year. And it's really just been the inner city apartment, those high-rise towers that were out of favour over COVID. But they're likely to fill up as the immigrants in particular come to our big cities, because that's where the jobs are going to be.
Yeah, we haven't seen rental price growth like this for 10 or 15 years, I guess, probably since the financial crisis, when a lot of investors left the market. That has taken a lot of people by surprise. I think we'll probably talk a bit about that towards the end of the chat. But yeah, as you mentioned, for new properties being listed for rent, asking rents are up about 10%. Now, it hasn't been reflected across every property yet, because of course a lot of rentals are on leases already. But yeah, for properties actually coming onto the market, rents are rising quickly, and in some areas they're absolutely storming higher, some of the coastal regions. So yeah, there is definitely going to be some pressure on rents next year.
Now, getting back to inflation that we were talking about a while ago, a little bit of inflation in many ways is a good thing. Rising inflation is clearly going to help the ballooning government debt. Australian government debt's now heading towards $1 trillion, which is double what it was before the pandemic. So the government's done its job. It actually came at a cost. So I think the government's going to be pleased to see a part of its burden being devalued if everything else, the cost of everything else rises.
Yeah, that's right. Inflation often gets a bad rap, and it can feel like a tax, particularly for lower income earning households. But it is a feature of the economy, not a bug. We do target an inflationary economy, and that's to try and encourage people to spend and invest their money for the future rather than hoard it. So it is intended to be an inflationary economy. It's just that in some parts of the world, things like freight costs have gone spiking higher. There's been shortages of goods and services in a lot of areas. So I guess that's a big question, particularly in America. Is this inflation transitory? And are we just going to go back to the low inflation environment we've seen over the past dozen years? Or is some of this inflation going to stick around? And I guess that's a big debate that's going on in economics at the moment.
Well, the low inflationary environments, I guess, occurred for a couple of reasons. One of it is the globalisation and the fact that we could actually buy things from other countries that were a lot cheaper than manufacturing back home. But that seems to have been reversed a bit recently, Pete, hasn't it?
Yeah, there is a bit of that. I think also it's been much easier to outsource to Asia, countries like India. You can outsource your IT work to Bangalore, or there's a lot of different ways to do business these days. You don't have to have full-time staff, and I think that has kept some downward pressure on wages. As you mentioned, the globalization trend has been very much disrupted over the last couple of years, so it'll be interesting to see how that plays out. And there's been inflation in a lot of stuff, secondhand cars and rents and other parts of the economy. So I guess a lot of that stimulus has found its way actually into inflation. That's the first time we've really seen that in, over a decade.
Well, when you come back to Australia, Pete, one of the shocks you're going to get is petrol now costs over $2 a litre. What was it when you left a couple of years ago?
Well, nothing would shock me being in Britain when it comes to petrol prices, because they tax it to high heaven over in Europe. So Australia still feels relatively not too bad, but as you say, comparatively higher than it was. I think actually we've seen a fair amount of this in the UK as well. I went to a few festivals over the summer, and just some of the prices that people have been charging now, maybe just trying to recoup losses from the last year, I don't know. But yeah, it's definitely very visible around the traps that there is some inflation, and that's same in America, exactly the same in UK, and Australia to a lesser extent.
For property investors, inflation is a good thing, as same with businesses for debts. On the one hand, house prices keep increasing. That decreases your loan to value ratios. It means you've got more equity. It also means that in the future, you're paying your mortgage with dollars that are not as valuable as they are today. And at the same time, property investors will benefit from higher rents that usually come along with higher inflation. So overall, for those who own assets, inflation is a good thing.
Yes, absolutely. And I guess this being the big picture podcast. And look, for people who are less familiar with the benefits of property investment, exactly as you said, when you buy a property, they always feel expensive in today's dollars, particularly if you're buying in a city like Sydney or Melbourne. But over time, because wages go higher, you're repaying the debt over time, and effectively the debt gets inflated away. And it is actually quite amazing over 10, 15, 20, 25 years how the big mortgage at the start of the process suddenly seems to seem quite piddling by comparison. And that's really the beauty of property investment. It just compounds over time. And it starts off slowly, but over time the capital growth starts to become more impressive and the debt just gets inflated away over time.
Another interesting result that came out recently, Pete, was the massive surplus that Australia's got, the trade surplus, which came at a time of this 2 years of global pandemic, which disrupted a lot of the global economy. We're still doing better than we have in a long time, selling a lot more than we're importing.
I haven't got the graphs and charts in front of me, but we've never seen a current account surplus of this kind of magnitude before. I think over the year for 2021, it'll be somewhere in the range of about $80 billion. It's absolutely enormous. So I guess, what's the dynamic there? We're still selling, for all of the talk of a downturn, we're selling a heck of a lot of iron ore and coal to China, and we're just not importing like we were. So, this is a huge benefit to the Australian economy. Yes, we went through a big period of uncertainty in 2020, but the government really stepped in with a stimulus. And I think because of the preceding mining boom, Australia just hasn't got the same level of government debt that a lot of developed countries do. So we were in a much stronger starting position. And one of the biggest stimulus packages of anywhere in the developed world, and Australia will fare very well as a result of that.
Well, moving into 2023, then our economy is going to pick up, and unless there's another major shock with coronavirus and our governments are saying they're not going to lock us down anymore, it looks like our economy is going to be good. That means businesses are going to need to employ people. Our job security is going to be good. As we've both suggested, interest rates are likely to remain low. So all that bodes really well for our property markets, because it's not just interest rates, it's also consumer confidence. You've got to be confident, you've got to feel financially secure in your job, otherwise you're not going to make a big decision, in particular as a home buyer, because market's really driven by home buyers, but also by investors. So consumer confidence on the whole, even though it bounces up and down, is improving, isn't it?
Yes, as you said, there's been a couple of setbacks with the lockdowns in Q3, but I think there's a lot less uncertainty this time around. I think if you look back at the consumer confidence numbers when we went into the first lockdowns in 2020, there was a huge amount of uncertainty because nobody really knew what was going to happen. But then the vaccines came along, the stimulus kicked in, the COVID disaster payments and the JobKeeper and the home builder. Consumer confidence has been down a little bit recently, but overall it's pretty solid, and it's only going to pick up, I guess, as we go into the new year.
Now, one of the things that hasn't changed in 2021 is the property pessimists are out there, the negative Nellies are out there. In general, it's the same doomsayers who've been wrong over and over again. But recently you wrote a great blog about the fact that you can't see house prices declining next year. Sure, eventually the cycle is going to end, and sure, eventually some properties are going to drop in value while others will just languish for a couple of years. That's just the way the cycle works. But would you like to give us the reasons why you think house prices are not set to decline in 2022?
Oh, I think it's pretty straightforward, really. I think cash rate's still zero, mortgage rates are still close to the lowest in history, and the borders are going to reopen. Hundreds of thousands of new arrivals coming into Australia, lots of demand for housing. Now, sure, mortgage rates will start to creep higher over time, but you're talking about creeping higher from the lowest we've ever seen. So I think the housing market will take momentum into the new year, and we'll probably find that in a year's time, at the end of 2022, prices are higher than they are today.
Look, I agree with that. Obviously, we're both saying the same thing, that prices aren't going to rise to the same extent as they have this year. Over the last 12 months, Sydney prices have risen 30%. I don't think anyone predicted that at the beginning of this year. 26% for Brisbane, almost 20% for Melbourne. Melbourne's been the laggard, hasn't it, Pete? But I guess that's partly related to the fact that we were locked down for almost as much time as we were allowed to get out of our houses.
Yeah, I think actually Melbourne could be a top performer next year. I think partly, as you said, because it's playing a bit of catch up after all that period in lockdown. And a few people nipped off interstate or down to the peninsula. But when things get up and running again, I think Melbourne will be a very attractive destination for investment and investors. I think as well, there are some parts of the market that got really overheated this year. There's been some frenzied activity in some of the regions and some of the coastal markets, and even within Sydney, you've got some parts of the market that have just gone ballistic. Other parts, like inner city units, haven't really done that much. So it's a bit of a mixed picture. As you said, you can't really have sustainable price growth at those kind of levels. I think it'll be just more sort of sensible and modest price growth next year. And as the Reserve Bank pointed out, a lot of countries like New Zealand and Canada and others and Germany have seen massive price growth over recent times. So it's not just Australia, but actually, if you look since 2017, price growth of about 27% for Australia's capital cities. It's not really out of line with the normal kind of rate of growth, because we did actually have quite a downturn from 2017.
I think that's a great point. In other words, from peak to peak, and we haven't reached this peak yet. The last peak was 2017. Over the intervening years, there wasn't much price growth. So if you even it out, 5-6% capital growth per annum isn't extraordinary. Now, again, all the property pessimists are predicating their scenarios of downturn based on higher interest rates and also based on that causing mortgage stress or people be defaulting or people not wanting to buy. Lower interest rates clearly have stimulated the economy, including pent-up demand, stimulated our property markets. But I'm not sure that a rise of 1% is going to be enough to put people into mortgage stress, especially if it's done slowly over a period of time. It's not going to be a sudden rise, a sudden jump, is it?
No, I mean, there were some quite glaring headlines about a 1% increase in the cash rate could effectively crash the housing market. But if you take a step back from that, imagine 10 years ago, somebody came to you and said, oh, if the cash rate was 1%, is the housing market going to crash? It doesn't even pass the sniff test, really. I think what people were referring to is a Reserve Bank housing market model from a few years ago. I think in 2019 it was. They said, if you cut the cash rate by 1%, this could inflate housing prices by, say, 28%. But actually, if you actually go dig into the model and the methodology, it's not saying that a hike of 1% would crash the market for a number of reasons, which are quite technical. The main point is that it's talking about changes in real interest rates. But the thing is, inflation expectations have picked up, as we already mentioned. We're going to see much stronger employment growth. I think we'll see employment rise from, say, 13 to 13.5 million over the next couple of years. We'll see very strong population growth. So all the dynamics are very different. And an increase in 1% for most borrowers, given their stress test with a 3% buffer, I just don't think it's going to move the needle that much. And in fact, mortgage stress is now at the lowest level on record because households have got so much cash stashed away.
Well, one of the ways of measuring mortgage stress is working out how much your mortgage is as a percentage of your income. Others are how much it takes to save a deposit. There's lots of different measures, but in my mind, the best measure, the real measure of mortgage stress is defaults or loan deferrals or loans that are 30 days overdue. And as you said, Pete, that's the lowest it's been for a long time. And with the large cash buffers a lot of Australians have got, with rising rents, with slowly but rising wages, I can't see mortgage stress happening with a 1% rise in interest rates as well. Of course, the unknown is what APRA is going to do, and they've recently come out with some extra discussion about what the banks should do to make themselves more financially stable. How's that going to affect lending, Pete?
Yeah, well, those changes were actually flagged some time ago. Changes to capital requirements for banks on their interest-only loans and so on. APRA also put into the legislation some guidance on how banks can act in a more timely manner if macroprudential measures are needed again, like they were a few years ago on interest-only loans and investor loans. Then they can be implemented in a more timely manner. Maybe they will also target high debt to income lending. So the legislation's being put in place, but at this point, the measures that have been implemented so far, namely the 3% buffer on new loans, well, that's going to reduce borrowing capacity by about 3 to 5% for some borrowers. It's not really going to move the needle that much. I think if there were more stringent measures put in place, then that actually could cool the market. But at this point, no.
Now, as we're getting to the end of a calendar year, I'd like to maybe share the biggest surprise I was got this year out of property, and I'd then like to ask you what yours was. But I think my big surprise was how strong the markets performed. I was on record suggesting they are going to perform strongly, but didn't really anticipate them being as strong as that. And the other big one that came out of the blue, in my mind anyway, very quickly, I didn't see it coming, was how quickly APRA intervened. On the one hand, they started talking about it, then all of a sudden they increased the buffer. Now, it's only just tapping the brake. It's not going to slow down the market considerably. But they, I think, were my two big surprises. What did you get surprised by in the property or markets or the economy last year?
Yeah, it's always interesting, this, isn't it? Because there are certain things that come along in housing markets or economics, and everybody agrees that something's going to happen, and then something completely different happens.
Yeah.
I think the big one for me, and in fact, sometimes, the fact that everybody's talking about something actually changes the outcome because policies are changed and so on. But I think the big one for me was when the borders closed, it was absolutely unanimous that everyone said there's a massive overhang of new property, vacancies are going to be a travesty. Now, we do have some areas, namely in Melbourne CBD, South Bank, and a little bit in Sydney CBD, where there's been a lot of empty units because there's no international students around. But actually, if you look around the country, I mean, rental vacancies as low as I've ever seen them. So, I mean, that has really, now everyone's an expert in hindsight, but that has really surprised most people. I think what's happened, there's been this kind of race for space, but a lot of people have bought second properties. They brought places up the coast, but kept a toehold in the city. So a lot of properties have actually been built, but they just haven't made it to the rental market. And in all around the country, there's markets with zero vacancy rates, essentially. And yes, the CBDs have got a few vacancies, but if you smooth that out across the country, well, the lowest vacancies we've seen in a decade. So I think that's been a real surprise.
You're right. That's a good one. Well, let's finish off today's chat with an interesting article I read recently, which suggested that Australia's inflated property prices are attracting money laundering attention. Apparently, Transparency International Australia's chief, Serena Lillywhite, said that Australia is going to continue to be a destination of choice for illicit funds, particularly corruption-related proceeds, which too often end up in our property markets. That's something that was a bit of a surprise to me.
Yeah, I mean, London, it's been well known for decades that a lot of money from, well, particularly countries like Malaysia and Russia and China, not to single them out, but there's been an awful lot of money that's flown into the London housing market over the years. Rules have actually been tightened up over recent times. It's not quite as easy for people to get those funds in, particularly from China. Australia's money laundering policies have actually been much weaker over time. I mean, many, many years ago now, I used to be an auditor. And in the UK, the money laundering laws are extremely stringent, but Australia's never really gone down that route. So I think that is potentially, rightly or otherwise, one potential sort of tailwind for housing, because as you mentioned, very often those funds do end up in property for one reason or another because it's perceived to be a safe asset. I think another thing that's been overlooked, I mean, Australian households are so wealthy now. Household wealth is about 10 trillion and rising. It's probably higher than that now. The superannuation guarantee is actually 30 years old next year. So we've got this huge wave of retirees who've actually spent 30 years contributing to their super. Now, if you average across all superannuation balances are relatively low because we've got a lot of migrants, but don't underestimate 30 years of investment in a stock market that's gone up about fivefold over that time. There's going to be a huge amount of wealth. And the difference from maybe 15 years ago is that cash in the bank is useless to people now. They need to put it somewhere, and it's not going to be just sitting in term deposits. It's going to go into stocks, into housing markets, commercial properties. So that's another tailwind for Australian property that isn't probably that well recognised.
That's a good point. Now, as we're finishing off 2021. One of the things that's not going to change in 2022 is that we're going to be getting together once a month and discussing the big picture. But every day you write your blog, and now you've actually got 2 podcasts, one related to property and one with Steve Moriarty related to the share market. I'm enjoying your podcast because every week you've got some great guests on, and I love your interview style where you're getting the best information out of them. Where can people get more information about you and about your podcast, Pete?
Goodness me, you've given so many different plugs there. Probably the easiest place to go is petewargent.com, or my daily blog is Pete Wargent Blogspot, and I link through to my podcast on there. You'll work it out.
Sure. Well, actually, wherever podcasts are found, you'll find Pete's Property Pod, and it's one I'd recommend if you're enjoying listening to Pete here on a regular basis. It's very different. You actually just get a guest, but you dig into the information about them over a whole show, and they're experts. So there's always, I enjoyed every week as I'm learning still, and I'm still keen to keep learning. I look forward to catching up with you again real soon. But next time we speak, you're likely to be in Australia.
Yeah, I can't wait. And I'm just praying they don't change the rules again before we fly in from Singapore. So yeah, I'm looking forward to some warmer weather because, of course, Europe is now freezing.
Okay, catch up with you then, Pete. Thank you.
Cheers. Thanks, Michael.
As always, Pete and I discussed a lot of information, and if you got some benefit from it, I'd love you to share it with other people who you think would benefit as well. Tell them about the Michael Yardney podcast, or leave a review on whichever platform you listen to this show. Now, if you want to take advantage of the opportunities that the market's going to bring us in 2022, because as you can hear, we're both pretty confident about the steps moving forward. Of course, it's not going to be the boom market that 2021 offered us. But if you want to take advantage of our property markets, why not have a chat with my team at Metropole? And remember, we've got no properties for sale, but we give holistic wealth and property advice. And it all starts by putting a plan together for you, a strategic property plan that will then give you some realistic expectations of what's ahead, what you can do, or what you have to do to achieve the sort of goals you want. And then you can end up using our buyer's agents, our wealth advisory, property management services, renovations, development, business advisory. We've got a range of services. Go to metropole.com.au, find out what we do, and I'd love to be part of your wealth creation journey. Now, I'll be back again real soon. In the month of January, we've actually got something special for you. There's actually going to be some extra podcasts, our summer series of podcasts, something to look forward to. But you can catch me in between these podcasts on social media. Just look for Michael Yardney or go to my private Facebook group. Look for the Property Update private Facebook group on Facebook, of course. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?